financial health analysis is very simple if you can understand these two things. But how to analyze the liquidity position of a company? For that, company has strong financial health. Hello my dear friends, welcome back. And in today's video, let's try to understand how to analyze the financial health of a stock. And for that, we use three key metrics. There are many metrics we can use to analyze the financial health of a stock. But in this episode, let's look at the three most important, three top metrics to analyze the financial health of a stock. Now, the thing is, to analyze the financial health, we analyze the balance sheet. We read balance sheet to analyze the financial health of a stock, and not just financial health. We read balance sheet to understand the financial health and liquidity position of a company. Basically, liquidity and financial health is more or less the same. This is basically short-term oriented. This is long-term oriented. Now, what is financial health? So, basically, financial health is nothing but whether the company can meet its long-term obligations or not. So, as an investor, we look at the financial health to make sure that whether the company can meet its long-term obligations or not. We try to understand the liquidity position of a company so that we can understand whether the company can meet its short-term obligations or not. So, the thing is, financial health analysis is very simple if you can understand these two things. Now, the first metric to analyze the financial health is debt to equity ratio, which takes care of the long-term and short-term borrowings of the company. See, the concept is pretty simple. A company without lot of debt. Let's assume that there is a company and it is a debt-free company. Such companies never go bankrupt because a company without debt cannot go bankrupt. So, we make sure to invest in a company with low debt. That is very important. So, the first parameter is debt to equity ratio should be less than 1. Debt to equity ratio is less than 1, and how to compute this debt to equity ratio? Like I said, I will make a separate course known as Investing Ratios Mastery. So, in this Investing Ratios Mastery, I will cover everything about how to compute these ratios and all. But here I am directly giving you the blueprint. So, the first metric is debt to equity ratio should be less than 1. Second is financial leverage. Financial leverage should also be less than 4. So, debt to equity ratio less than 1, financial leverage less than 4. If a company has these parameters, then its financial health is strong. But how to analyze the liquidity position of a company? For that, we can use interest coverage ratio. There is a ratio called interest coverage ratio. This should be greater than 5. If the interest coverage ratio is greater than 5, then its liquidity position is strong. So, to put it simply, if a company's debt to equity ratio is less than 1, financial leverage is less than 4, and interest coverage ratio is greater than 5, then you can consider that company has strong financial health. That's it for today, guys. And in my next episode, let's try to understand the 5 sources of a company growth. Trust me, guys, next video is going to be very interesting. And in case if you are new here, then please consider to subscribe my YouTube channel and don't forget to hit the bell icon as well. So that's it for today, guys. This is Vishnu Dekonda signing off.